Hello friends. Last week, I hope you had a good trading week. In my last week's video, we saw why banking stocks were extremely important to sustain a uptrust in the overall markets. And there you have it. The bank nifty was sluggish, and because of which the nifty itself got a little dragged down. All that in greater detail later on in the video, and I'm also going to cover what are the 5 topmost things that you will have to monitor in the week ahead if at all a pre-budget rally is to occur. But for now, let's dive right into our usual statistical analysis of the markets, and coming up on your screen is the weekly market roundup window, which clearly tells us that it was a broader based Nifty 50 which led the bullish charge upwards. The Bank Nifty actually surrendered as much as the Nifty 50 gained. The US dollar index fell, and that basically created a relief rally in emerging markets, including India. It also triggered some amount of buying in gold as a safe haven, but crude oil and silver corrected a little. Natural gas went up a tad because of the expiry impending ahead, and the USD INR was basically unchanged. So the rupee was unchanged against the dollar. The Indian 10-year benchmark bond yield fell by 1 basis point. It might appear 6.99 in the last and the current week, but it's just a problem with the decimal rounding off. The bond prices did move up a bit, which is why the yields fell by 1 basis point. NSE market capitalization rose by a little over 0.5%, so the broader based outlook was still in favor of the bulls, but the rally did seem to be slowing down a bit. Market wide position limits rose 3%, which is routine ahead of the expiry. And the US headline indices went up, barring the NASDAQ, the technology heavy NASDAQ, and that provided some amount of tailwinds to our markets. Now, friends, I come to the ratio chart of the Bank Nifty divided by the Nifty 50. If you go to TradingView in the script search toggle bar, just type Bank Nifty / which is divide by Nifty and click enter. You will get this ratio chart. This is a weekly chart. What I'm basically trying to prove to you is since the last 3 trading weeks, the Bank Nifty, which used to typically trade around 2.25, 2.35 times the Nifty 50, is now trading at 2.15 times, and it has fallen in the last 3 trading weeks. Do remember what I told you last week and in many weeks prior. Why is the banking sector important? Friends, I'm a firm believer of the fact that nothing happens in financial markets without a reason. And since these markets are financial, the reason also has to be financial. And WYSIWYG, what you see is what you get, does not exist. Now, the reason why banking stocks need to go up is because of the sheer weightage that they enjoy in the broader markets. Look at the weightage metrics on your screen right now at 34% plus. The numbers 2, 3, and 4 in weightage terms combined do not enjoy the same weightage that the banking and financial sector has. So, if at all a pre-budget rally is to occur, the banking stocks must move up, which is why the Bank Nifty versus the Nifty 50 ratio chart. You can plot it yourself, very easy. Friends, I now come to our in-house indicators. I start with the market wide position limits, or MWPL. This is the extent of exposure utilized by traders as compared to the exposure allowed by SEBI. At 40.78 last week, we are at the highest in the 2 weeks, in the commensurate week, 2 weeks after expiry of any series in the last 20 weeks. That tells you that buy and hold traders or swing traders were actually holding on to their positions and adding to them ahead of the budget announcement. So these guys are deep pocketed as compared to intraday traders, and they seem to be having a lot more conviction. But do remember, high MWPL brings with it high volatility, because if anything was to go wrong, a huge buildup in positions also means a huge unwinding of positions. My online family will remember, ahead of the election results, I was giving you daily and weekly MWPL changes on my free Telegram channel, and that helped you a lot. We caught the way the public sector unit stocks basically fell sharply on the election result day on 4th of June. Here again, now there is some news announcement by Money Control today that privatization of PSUs may be deferred, and the government might just try to streamline their operations and reform them, cut corners, cut expenses, and make them into profitable units. So that might lead to a little bit of unwinding, and the trick here is always MWPL, which is why I encourage you to maintain MWPL in tabulated columns like you are seeing on your screen. Now, this MWPL is something I update on my social media accounts every day late in the night. Do connect with me. My contact coordinates are on your screen right now. My Telegram channel is one place where I put all my research in one platform, because there is no word count limit, and it's very easy to access. So if I was you, I would watch MWPL very keenly in individual stocks as well as the overall market. Now for stock and futures turnover, stock and index turnover, I beg your pardon. In both the index and the stock futures, turnover went up a tad, which means trading participation rose a little after falling sharply, routinely that too, because of expiry in the prior week. Now, in the next 1 or 2 trading weeks, turnover becomes quite critical and important to look at, because we need higher trader participation, especially if prices are rising, to tell us that there's a whole lot of buying taking place. If prices are going up on smaller volumes, that means this is more of short covering rather than fresh buying. So please, let's monitor that. And this again is tabulated as a summary in my daily updates on my social media accounts, particularly my Telegram channel. Friends, I now come to the advanced decline ratio, which after the price itself is the most leading indicator of them all. Now, the Nifty percentage gain came down sharply to 0.73% in the last week, but the advanced decline ratio, this is an average of all trading sessions of the week rather than Friday to Friday. Now, the entire week's average has collapsed to 0.86. What does it tell you? Now, what does it tell you? It tells you that for every 100 losing stocks, there were only 86 gaining stocks. So losers were actually outnumbering the gainers. That's not good. And this is a one marshmallow metric. The marshmallow theory is in these tutorial video, and the hyperlink to all my past videos which I want you to watch are in the description below this video, as well as in a pinned comment below this video. So advanced decline ratio is a one marshmallow theory, and MWPL is a two marshmallow function. So do check them out. Friends, I now come to the Nifty and Bank Nifty prompt month futures basis. Now, what is basis? It's the premium prevalent in the future as compared to spot. Just like options premium erode as expiry approaches, the futures basis also erodes as expiry approaches. But all other factors remaining constant. Higher basis tells you there's a high risk appetite. Why? Because traders are willing to pay a bigger premium to go long. And lower basis tells you that there is less buying enthusiasm, which is why basis has gone down, and which is what you are seeing in the Nifty. The Nifty basis has come down by more than 50%. The Bank Nifty basis has gone up. In spite of the fact that the Bank Nifty logged losses last week, it tells me that at lower levels, Bank Nifty enjoyed the short covering, whereas Nifty 50 was subject to selling at higher levels. Friends, I now come to our in-house indicator, the impetus. You won't get this anywhere on the internet. You've been enjoying it for almost 4 years now. And last week, what we saw was the indices might have gone anywhere that they did, but the impetus readings are near the period low of 20 weeks. That tells me that momentum and force in buying was very poor last week. Now, if at all I want a sustainable rally ahead of the budget, I want prices to go up, I want volumes and open interest to go up, I want the impetus to rise as well, without which I would call it a lame one-legged rally. So let's watch that, please. This again is something that is covered in our daily updates. Friends, I now come to the lift, weight, thrust, drag indicator, which is the most watched indicator from us. Again, an exclusive in-house indicator, not available anywhere on the internet. The Nifty has clocked smaller gains last week, but the LWTD has collapsed from plus 0.48 to minus 0.50. What does it tell us? Now, here again, there's a tutorial video for deciphering the LWTD indicator. Make it a point to watch that video, please. The link is in the description and in the pinned comment below. What it basically tells you, when you watch that video, you'll understand that at lower levels, the indicator is telling us that fresh buying support might be mild. Does it tell you that there will be no buying at all? Hey, I'm not saying that. Short covering can always come. But can short covering result in a fresh all-time high? No. It can lead to a temporary blip up, but an all-time high will come from aggressive fresh buying. And the LWTD seems to indicate that aggressive fresh buying is a little while away. This is a weekly chart. The daily figures are updated on my social media accounts. Friends, our in-house indicators done. I now come to the bond market, which are very close to my heart. I've been monitoring this market since many, many years, and I cover them before I cover equities for a reason. This is the market that funds the asset prices of all other asset classes. This is a fountain of money supply. Now, the bond yields fell marginally by 1 basis point. That means bond prices went up a little. That saved the bank nifty from the blushes, because banks tend to be the biggest investors in bonds by the very nature of their business. And since bond prices fluctuate, it can result in a mark-to-market positive or a mark-to-market negative implication for their holding. Now, when bond prices go up, there's a notional or a mark-to-market profit on their bond portfolios. Then the bank nifty tends to go up. Now, this is something that everybody does not tell you. That's because many of the people don't really bother watching bonds. Hey, bond markets are boring. Why do you want to watch them? Hey, because it impacts the banking stocks, especially the bank nifty. You cannot be a bank nifty trader and ignore the bond yield. So here again, the bond yield is covered every day on my social media accounts. Do connect with me, please. Friends, the bond market's done. I now come to the bank nifty, which was a rank underperformer, and like I told you last week, the chart of the Nifty 50, relatively speaking, looks stronger than the bank nifty. And as you can see on the daily chart on your screen, this index has lost 0.72% because it rose on only 2 days out of 5 days last week. The price is above its month-long moving average, but the average itself appears to be flatlining or going sideways. That tells me that there is some amount of sluggishness coming in. Do remember, impetus was down on both indices. Now, with a 34% plus weightage in the Nifty, banking and financial sector stocks must rise, otherwise it will drag the Nifty down with itself. Now let's turn to the weekly chart that shows a small-bodied bearish candle with a negative closing. That tells me higher levels are witnessing overhead supply. Now, what's overhead supply? When traders are stuck with long positions at higher levels and they endeavor or they try to get out at break-even prices, thereby delaying the rally a little bit. Now, this overhead supply must be absorbed before the all-time high can be overcome and the index start to rise again. Friends, in the week before last, this index was number 6 on the basis of statistical beta ranking that I maintain in-house. Last week, it maintained its position at number 6, so volatility remained constant. Last week, I estimated a range between 54,350 on the upside and 51,000 on the downside, which held perfectly well. In the coming week, I estimate a range between 53,900 on the upside and 50,650 on the downside. In addition to these levels, please do connect with me on our free Telegram channel, because I update the daily, weekly, and monthly pivots for all three indices, and they will help you laser precise your trades even further. Friends, the Bank Nifty done. I now come to the Nifty 50, which saved the day by rallying almost equal as compared to the declines of the Bank Nifty. The daily chart on your screen tells you that this index rose on 2 out of 5 trading sessions, but it closed near the all-time high, and the chart is much more cleaner and stronger in relative comparison to the Bank Nifty. The price is above its 20-day exponential moving average, which is a month-long holding on cost of an average trader. So the short-term outlook is positive. Now, as the ratio chart we checked before told us, the Nifty has been outperforming the Bank Nifty since the last 3 weeks. This has to change. If the rally is to have stronger legs, the Bank Nifty must pick up momentum immediately. Remember what I write in my Live Mint column, that the Nifty 50 and the Bank Nifty are like two wheels of a bicycle, which is called the market. Both must go in the same direction. You can't have one going this way, the other going this way. Otherwise, you're going to have a bicycle toppling like you see it. We don't want a crash like that. So both indices must go in the same direction. Friends, I now come to the weekly chart. The Nifty shows a bullish candle, but the body is a whole lot smaller. That means the momentum or the tempo was slower. Hey, that was confirmed by the impetus chart itself. The price is above its 25-week exponential moving average, which is a proxy for the 6-month long holding on cost of an average investor. So the medium-term outlook remains positive for now. But since the last couple of weeks, I've been telling you the difference between the price and the moving average is widening. And therefore, there is a possibility of some mean reversion occurring, and consolidation and or declines might just occur. So we need to be a little watchful out here. Friends, last week, this index was number 11 on the basis of our statistical beta ranking that we maintain in-house. It slipped 8 notches to number 19, which is a comfort because lower volatility would mean better ease of trading for an average retail trader. Last week, I advocated a range between 24,925 on the upside and 23,725 on the downside, which held perfectly well. In the coming week, I estimate a range between 25,100 on the upside and 23,925 on the downside. Friends, here again, please refer to our daily, weekly, and monthly pivot levels on our free Telegram channel. It'll help you laser precise your entries and exits even further. Friends, before I proceed in this video, I request a few seconds of your time. I have the following request. I don't want any money from you. I don't want anything from you. I do not believe in providing paid services. But my videos take a lot of time, effort, and energy, including money. It would help me a lot if you help me to reach out to a wider audience by sharing these videos with smart traders like yourselves, your friends, your family, your social media groups on WhatsApp, Facebook, Twitter, Instagram, etc. I'm putting in the effort to make these cutting edge videos which are not being made by anybody else. At least make it worth my while by helping me reach out to a wider audience. If you can help me do that, I would greatly appreciate it. Friends, I now come to the retail risk appetite, which is the last bit of statistical analysis that I'll do. We gauge the risk appetite of retail by way of their footprint or their participation in the 4 derivative segments: index and stock futures, index and stock options. Let's see how much risk appetite they showed last week. Now, coming up on your screen is a weekly chart of the turnover contribution of these 4 segments. The index futures turnover fell by 1 basis point, is given as a blue line. Stock futures turnover contributed 0.02% more, it's indicated as a red line. Now, the fact that futures turnover was smaller tells you that futures which demand a higher amount of capital, mark-to-market payments, and higher volatility saw lower participation. That means risk appetite was somewhat lower. Let's see in the options segment. The safest options are the index options, but here the turnover fell by 36 basis points. And it is shown as a green line. The stock options turnover went up commensurately by 36 basis points. It is shown as a purple line. So here what we are seeing is that risk appetite was quite subdued. Traders were preferring to play in options rather than futures, which demand a lot of money. I don't really blame them. A lot has to do with SEBI's committee's proposal to raise the FNO stakes or the FNO lot size from the present 5 lakh rupees to the proposed between 20 to 30 lakh rupees. All right. So I've recorded this video up here. The hyperlink to this video is in the description and pinned comment. I've given you some remedial steps of what to do in case the lot sizes are actually increased. Please do give it a try, give it a look, and take heart in the fact that there are always solutions if there are problems ahead. Friends, I now come to the 5 telltale indicators that you must watch for the pre-budget rally to kick off. Now, this should be a broad-based rally and participation of all heavy-weighted sectors, starting with bank and financial sector stocks, must happen. On your screen is the grid. I want at least the top 5 or 6 weighted sectors to perform very well. Point number 2, the qualitative and quantitative aspect of the rally must both be strong, which means MWPL or market-wide position limits, traded volumes, advanced decline ratio must rise together with the price to tell me that this rally actually has stronger legs. Now, point number 3, retail risk appetite must go up. Again, quantitatively and qualitatively, which means the turnover in these 4 segments should show that futures participation has increased dramatically. That's where buying comes from deeper pocketed, richer traders because futures demand a lot of money. If future contribution starts to go up, it would be an indication for a statistical trading model a participant like me to say, hey, the big guys are here and they are buying. I'll feel safer buying when big money is buying because they normally do not lose. Point number 4, ahead of the budget, the pre-monsoon sectors must show rising stock prices. That is PSUs, fertilizers, defense, education, healthcare, infrastructure, basically sectors that will promote job growth. They'll basically kickstart the GDP into a higher growth area and their stock prices must reflect it. If at all, this condition is also met, condition number 4, that raises the weight of evidence, and statistical weight of evidence is all that I look at before I would start going and initiating long positions. Now, point number 5, I will keenly watch the Income Tax Act announcements for tax reforms or changes, if any, on stock market traders. A lot of people may not take this seriously, but market prices by stocks, commodities, bonds, foreign exchange are also determined by emotion. It's not just mathematics. And this tax is a very emotional subject. So if at all taxes are raised, there might be a little bit of unwinding here and there, maybe a little more than a little. We'll have to wait and watch. So if people are gung-ho, they should be buying. If they are very, very gung-ho that no additional taxes will be imposed, then I want to see this happen in front of my eyes. So if at all, I'll be watching these 5 points. I want at least 3, if not 4, tick marks out of these 5 before I go out there and initiate fresh aggressive longs. Friends, now for the last segment of this video, my trading strategy for the week ahead. Last week I told you I intend to maintain my tail risk hedge, and that strategy remains in place. I've explained what the tail risk strategy is in this video. Believe me, you got to take it extremely seriously. This is what saved our skins and also made us money. In the fall of 4th June election result day, and I updated you on my Telegram channel with daily and weekly MWPL data points, as well as I told you watch where the highest concentration of MWPL or market-wide position limits are. Remember the tabulated stock-wise MWPL that we maintain. Why do we maintain that? Because if people are trapped, they tend to want to exit from those places where their concentration of trades is the biggest. That is where crowded exits occur, and that is where traders make the most amount of money by capitalizing on this crowded exit. So focus on those stocks which have the highest amount of MWPL. Do yourself a favor. You'll thank me for it. We did that before the election results. Now do that again for the run-up to the budget. I will of course be updating you on my Telegram channel. I stand committed. I also told you that I would adopt a theta decay strategy in the non-linear derivative segment, and that too in the interest rate sensitive sectors. Now, what are interest rate sensitive sectors? Banks, NBFCs, companies that depend on EMIs for sales, and or those companies that are very heavily debt laden with loans that they've taken from private and banking institutional lenders. Now here it seemed to have worked out pretty well. Take a look at the tabulated column on your screen. What do you see there? Take a look at the sectoral indices that have fallen. Auto fell by 1%. CNX Finance fell by 0.16%. Metal fell by 2.63%. MNC fell by 0.23%. PSU Banks fell by 2.09%. And CNX Realty fell by 2.32%. Now, out of these 4 sectors are something that interest me a lot, and no prizes for guessing. They are all joined at the hip like Siamese twins. They all have the same umbilical cord through which they feed themselves. CNX Auto. What auto? How much of auto sales are done on EMIs? Majority of them. So this is an interest rate sensitive sector. CNX Finance, I don't need to tell you, it is an interest rate sensitive sector. Now, PSU Banks, of course interest rate sensitive. Banks are concerned with interest rates. And real estate stocks, here again, interest rates sensitive. How many properties do you think are sold on cash down basis or full payment basis versus bank loan EMI based property sales? Take a look at yourself. I'm not giving you rocket science. I'm just presenting you with statistical weight of evidence from our 2 in-house trading models. The behavioral model is Barracuda and the statistical trading model is IBEX. So the more you mechanize things, the less emotional you are, and the more we are ready for Western high-frequency traders, algo traders, and artificial intelligence-based traders who are likely to come to India within the next 1 year. And we'll be ready to welcome them with our own trading systems. So the interest rate sensitive sector should not have come as a surprise to you. And it is the same sector that I will pursue in this week again. But admittedly, my exposure this week will be a whole lot smaller. You know why? Because Wednesday is a holiday and this is a week of 4 trading sessions because of Muharram. On the 17th, we have a holiday. Now, last week I told you that base metals may attempt to rally on commodity exchanges, but they'll run into overhead supply. Overhead supply is when traders are stuck with long positions at higher levels. When the price goes up there, they tend to sell. Now, this has to get absorbed before which no fresh buying can come. Now, overhead supply is limiting the upsides of many industrial metals. How does that concern you? You may not be a commodity trader, but hey, stocks of metal mining companies will react accordingly. Mining companies will derive profits from rising metal prices because it's their finished product. If the price of the finished product is coming down, then metal mining companies' profitabilities and therefore stock prices also tend to come down. We traders are brain warriors. We fight and win with our ideas. If you keep your ideas simple, straight, and no nonsense, you can actually correlate multiple asset classes, program them into a trading model, and stay ahead of the crowd because staying ahead is winning. I will continue to focus on public sector units because, like I told you, there may be delayed or no privatization. They might just restructure them. So, a flurry of activity is expected on these counters. I will, of course, focus on those where MWPL is the highest. Out of these PSUs, I will pay particular attention to public sector banks or PSBs, OMCs, oil marketing companies, power generation, power distribution, energy counters, they will remain on my radar. Friends, last week I told you I expect bullion to encounter buying from institutional buyers and therefore cushion declines. I expect that to remain the same because the long-term bull market in bullion is still on. I've recorded two videos a couple of months ago. A, on what is the outlook on bullion, and B, where to buy bullion cheap, pure, get it tested, and avoid getting cheated at all costs. The hyperlink to those videos are in the pinned comment below and in the description below this video. Please check them out. I also said I do not subscribe to the super cycle theory. I've been saying that since 2021. I don't think there is a super cycle in gas and oil. Now take a look at the DCA, the derivative chain analysis of crude oil. Hey, are you surprised? There's backwardation. MCX WTI crude is actually trading at a discount in the mid-month series by over 100 rupees. So that itself tells you what is happening in the market. I rest my case. Super cycle, you believe it if you want to. Friends, I'll be expanding the amount of content that I'll put on our free Telegram channel as the budget announcement comes closer, just like I do before every major event. Do connect with me on our free Telegram channel and let's stay focused on staying ahead of the crowds because staying ahead is equal to winning. I thank you for your patience in being with me in this video. Till we meet again in my next. This is Vijay Bambwani signing off for now, but not before reminding you to click like on this video if you liked what you saw. Subscribe to my YouTube channel if you haven't already done so. And in the comment segment, do let me know what else you want me to record for you and I'll try and accommodate you as much as possible. And hey, share this video with your friends and family and all social media groups. I wish you have a very, very profitable week ahead. Take care. Bye-bye.